Welcome back, traders and investors. We have Peter Tchir on the line of TF Market Advisors. He's traded over $1 trillion of fixed income products during his career, and he's going to come on today and talk about the fixed income market. Peter, how you doing today?
Good. Yourself?
We're doing good here on this Thursday. A little bit of a sell-off here, but just another opportunity for the Bulls. But give us a little bit of your education and your market background.
Really kind of came from the credit side, so a lot of high yield and structured credit, and ultimately really shifted over to the credit derivative side. Had an interesting background in that, and there's the CDS indices that probably saw a lot of during the crisis. I actually was one of the board members that helped found that product, and that's where we traded that. So it's, a lot of our customers, as I traded that, were the big global macro hedge funds, and that's kind of what dragged me from a more, say, specific credit background and high yield into this, global macro, risk on, risk off type trading. And since then, we've been able to build a successful business around it, and currently actually have Green Capital running their macro strategy. So we brought our customer base of TFs into Green as a good way to expand and grow.
And so most of the products that you're trading derivatives, are they off-exchange products?
Yeah, currently right now, I think there's one exciting part of the credit derivative market in particular is we're seeing it move into clearing. So you're seeing ETFs, like PIMCO has one ETF, HYS, which is a high yield fund, which is an active user of cleared credit derivatives. And we're actually involved in a project with CME and S&P to list a futures product. So kind of, all this Dodd-Frank legislation is slowly taking effect, and I think you'll see more of these products kind of move to the potential end users. And there's also a couple people working on ETFs that would be CDS-based, solely CDS-based rather than just using them as a part of it. So I think we're going to see more development on that. But I spend most of my time, really we're very active with our clients on the E-minis, on a lot of, European equity futures and treasuries and treasury futures. So we have a very broad mix, but it's kind of high-level macro trading rather than specific stock trading.
Okay, so you're not creating these products. You're more taking a look at products that are out there and then seeing if they're suitable for your clients. You're not, because there's definitely been some negative press as far as products being created, especially during the financial crisis, complicated swaps and derivatives, and and then the brokerage firm taking the other side of them and them going to zero. So you're not creating the products. You're out there analyzing the products.
Right. We're out there analyzing it. We're kind of looking for where the value is, where there's opportunities to see what is wrong. We want to highlight things that we think are bad. At the same time, what is good. And we spend a lot of our time with a more retail-based client base on ETFs and really taking a look, particularly how fixed income ETFs, I think, have revolutionized how people can actually manage their fixed income allocations. And that's something that's been growing. And I think there was all this talk last year about this rotation out of equities or out of fixed income into equities. I think some of that's gone on, but really I think what's happened is people are becoming more effective at managing their fixed income portfolios. You can use things like BKLN, which is a leveraged loan ETF, to take exposure out of the high yield bond market into this market, which is secured, which is floating rate. You can move from the high yield market into investment grade. There's now many more European credit ETFs. There's EM. There's obviously some of the old muni ones. So I think it's really expanding what people can do with their fixed income portion, and that's been something we spent a lot of time on, kind of how that can be managed, and it very much mirrors what we're seeing at the institutional level. On the institutional level, many of the fastest growing areas of fixed income are actually not product specific. So in the old days, you would have a mortgage fund at a big manager or a treasury fund. And now it's their multi-sector and total return funds that are attracting most of the money. As people realize they want more management of how they are positioned within fixed income. And that can be the big difference in your total return is not whether fixed income, fixed income is fairly complicated and different products will react to different markets differently. I think I said different about 10 times there. But it's really analyzing that and positioning yourself correctly that can be the big difference in generating real returns in your fixed income portion, even with low yield environments.
How's the liquidity in some of these fixed income ETFs? Like we know it's very liquid in some of the equity ETFs, but some of them are thin too. Are most of your fixed income, are the spreads pretty tight on these things when they're traded?
Yeah, I think the spreads are pretty tight. We tend to look at the larger ones. So I really get uncomfortable with anything really below $1 billion. Occasionally, if it's kind of a market access type product where it's something that you couldn't get exposure to any other way, maybe we go down to 500 million. So we're really looking at the big ones. We tend to avoid the smaller ETFs specifically for that reason. I think the one thing people make some mistakes on is, though, you've got to be, I think, much more careful with a market order, particularly if you're doing any size in some of these.
Right.
Because market orders can shift it, 0.3%, whereas if you put a limit order, you can often get filled. So I think you got to trade it a little bit differently, a little bit patiently, but we see good liquidity in the ones we've been involved in, and we think that will continue as more market makers trade it. But we do focus on the bigger ones specifically for that reason.
Are there too many ETFs out there though? Like every time I look, like especially on the equity side of it, there's just so many ETFs and a lot of smaller ones. It seems like there's almost more ETFs than there is stocks now. Is that an issue? Or are we like getting, just having too many ETFs out there?
Yeah, I think that becomes an issue. There's some, we've been pointed to, we'll have an idea maybe in energy, and some say, oh, you got to look at this ETF, and really it's 30% might be one name and 70% three stocks. So to me, again, I like the big, broad-based market ETFs. So, like a Spider, clearly, or IWM. Those, to me, make sense. Maybe an XLF makes sense. Beyond that, you start getting, I think you're better off probably going to single stocks because you're not, it's an ETF maybe in name only. So, again, I like the big, broad ones that are really market-focused rather than too nichey. And I think, again, we only look at the ones that really are $1 billion or more for that reason too, because you don't really know what you're going to get in the other. You're going to be subject to some trading. So we like the big liquid ones and really, market focused rather than too specific.
Okay.
And we generally stick to, one thing that really concerns me is I'm not a huge fan necessarily of the managed ETFs, but I'm particularly concerned there's this push, I guess, to not have to disclose ETF holdings for managed ETFs, and that I do not like at all. I don't understand it because I think how can you manage, how can you trade something where you don't see the liquidity or you don't understand what's in it? And at the same time, we do talk to our clients, if you have more of a 6-month horizon, certainly to a year, I think you're supposed to look at mutual funds again. I think mutual funds, there's this whole shift towards ETFs, and some of it should go back towards mutual funds. Again, when I look at, say, the leverage loan space, which has attracted a lot of attention, BKLN has grown from less than $1 billion to $7 billion or something over the last year. To me, leverage loans should be a core part of the asset. If you're going to hold that for a long time, you probably want to move into a mutual fund where I think you can get better returns with the managers. So I think to me, ETFs really about being able to adjust your beta quickly, but if you have a longer-term view, I think the mutual funds are still very good, and that's something that I think there'll be a shift back, or, all these cycles go through these phases, and I think the love affair with ETFs is slowly calming down a little bit, and people will go back to some more traditional management, especially with volatility so low.
Joel, did Garrett have a question for, you were saying
Yes,
Garrett
yes.
from our news desk. Oh, there you are, Garrett.
Peter, how you doing? It's Garrett.
Hey, Garrett, good to talk to you.
Yeah, it's good to finally get in touch. I wanted to ask you about complacency in the credit markets. I've been writing on a macro level just about breakdowns in confidence with, using some of the indicators for economic performance and just kind of some of the overvaluation that, Yellen was speaking to yesterday. And I'm wondering, are you seeing any of this in either specific CDSs or spreads in any of the assets you trade, if there's a level of complacency where maybe guys are not paying
Yeah,
for
we
the
started
necessary risk
noticing this.
reward payment?
I'd say last week was kind of really the first week we've been getting a little bit more squeamish about what's going on in the high yield market in particular. And what we're starting to see is, and it's really been noticeable even through the HYGs and J&Ks, they're kind of drifting lower every day. You're seeing these outflows. And I think the market, what people have to understand, I think, about the credit market, if you're not used to it, it's this methodology where a trader sends out a set of prices on a Bloomberg message. People pick up the messages, they look at it, they can try and call the dealer, see if they'll get the price. They scan through various messages to see who seems to have the better price. But they're not live markets. They're not tradable. It's not like an electronic exchange anywhere. So I think one of the things that we started to see is this over the last over the last week, there are many more people, I think, kind of looking to sell bonds than really looking to buy. No one's hitting the bid, so no one's really selling down yet, but it starts to feel very heavy. As I talk to dealers, everyone's basically complaining that any bond that they've bought, they can't sell. Conversely, any bond they're short, they can't buy back, but that's a slightly separate issue. So I think the dealers have used up what little liquidity they like to provide. They're getting caught long. There seems to be better selling pressure, retail selling. And one of the things that's actually accelerated this is typically in the high yield, you don't really hedge for rates. But with all these 4.5%, 5.25% double B bonds out there, people have started hedging with interest rates. So they've been short treasuries. And all the problems in the repo market are starting to hit that. Right? So one, you're getting fails, which no hedge fund wants to deal with fails. Separately, you're also having these issues where periodically these trade specials, so your short costs 3.5% to keep overnight, which really eats into your spread. So I think we're seeing just a little bit of tentative nature in the high yield, and I think that will kind of accelerate over the next week. And as that accelerates, I think you'll see a little bit of a risk-off trade brewing in the entire market. Because this is an equity market that has relied very, very heavily on the ability to finance dividend and to finance stock buybacks with cheap credit.
Excellent point there, Peter. What you're doing with the fixed income market and the derivatives associated with that, and really also when you tie in the whole market here, it comes down to interest rates. It comes down to the Fed's position on QE and the rate of tapering. So could you just give us your short term outlook for interest rates and also your long term outlook?
Yeah, I think in the short term we're going to see interest rates rise at the front end in particular. That 3 to 5 year range, I think, has been underestimating what the Fed will do. Fisher came out very hawkish yesterday. And on top of that, what I noticed yesterday and this morning is the number of really negative articles about the Fed has really ratcheted up. We saw Guggenheim come out with something. Rick Reeder at BlackRock came out. So I think there is going to be intense pressure on the Fed to normalize rates. And one of the things when we look at it, currently you're at 0%. So, okay, you want lowest rates possible. 0 is a natural number. Once they raise rates, the only real next natural number to get to is the rate of inflation. So Fed funds is typically right around the current inflation rate. That's say 1.5%. So we think you're going to get there. That will push 5-year yields up. I think short term, the long bond and 10-year are going to remain relatively stable. Like I would not be short the long bond. I hate the TBT trade because I think what people are underestimating is curves are very steep. So the difference between 2-year spreads and 30-year or even 5-year and 30 is still very high. So I think we can see the front-end yields move higher without pressure on the back end. It's expensive to be short, though, so I think we're going to see a squeeze and some short covering come in. And then finally, as they start raising rates at the front end, I think people are going to be concerned about growth, inflation, and maybe even equities, and that will actually keep rates slightly lower than they would be otherwise. And then the other thing I think we forget about is German 10-year bonds yield 1.15%. So as much as we might say 2.6% seems stupid on the 10-year, it's actually very cheap relative to what you can get lending to Germany or France or Japan's, I think, at 0.6%. So that's kind of my short-term view to medium-term view is that the rates will go up. It will impact equities, will impact credit, and create a little bit of a risk-off environment. But all of that remains reasonably supportive for 10 and 30-year bonds, so I would not be in TBT. I'm fairly neutral. I don't know whether I would own TLT right now, but I definitely would not own TBT.
And the chart is confirming that. All right, we've had Peter Tchir on of TF Market Advisors. Definitely an expert here in fixed income products, giving us his take on the fixed income market as well as interest rates. Peter, I wish we had some more time for you. We definitely would like to have you on again. The fixed income market is not something we give a lot of attention to, and we appreciate your expertise.
Great. Thanks very much.